The rate that stops the nation today, the Reserve Bank moved for the 13th time. Cash rate has hit a 12-year high. In today's video, we're going to break down everything you need to know, the new governor's notes, and what her outlook is for inflation. Nathan, start us from the top. What has happened?
Yeah, well, we've seen Michelle Bullock lead her second meeting as governor, highlighting the fact that there's indeed a risk of sustained inflation and opting to move the cash rate up by 25 basis points, which has reached a 12-year high at 4.35%. This is the 13th rate rise since rates started rising in May of last year, and it signals a significant shift in the Australian monetary policy. Jaden, talk me through why this is the fact. What are some indicators that the Reserve Bank was looking at?
Yeah, the Reserve Banks had to push back their inflation target. They were hoping to have everything under control by about August next year. They've said, well, we're probably going to not be back on target until the end of 2024. And despite, there was sort of slower economic growth early in the year, things have really picked up. The property market's obviously picked up. Migrations exceeded expectations with 500,000 new entrants coming to Australia, and the cost of things have stayed up.
Definitely. Well, let's have a look at what it means for the average borrower. Let's say you have a $600,000 mortgage. This latest increase is going to take $100 out of your pocket in extra payments you need to cover per month. What this means is since rates started to go up, since the beginning of the rate hike cycle, borrowers are now paying roughly $1,400 more for the same mortgage.
Interestingly as well, if you're looking at buying a new property and you're impacting your borrowing capacity, this latest rise has taken about 2 to 3% off your potential borrowing capacity. So it can make a pretty big difference. If you otherwise could have borrowed $1 million, it's $20,000 to $30,000 less you can have in your capacity towards the next purchase.
Definitely. And if you have a mortgage and you haven't reviewed it in a while, it might be time to call up your bank, have a chat with them, and see if they can get your rate down. We know that banks do a thing called loyalty tax. So the longer you've been with your lender, there's more chance that you're paying a higher rate than what they're giving to new borrowers. That's where you want to touch base with your bank and ask them the question, can you get my rate down? Because this has highlighted the fact that mortgage repayments have increased so significantly since rates have risen. Really time to review your mortgage and see what it looks like. Jaden, we've seen inflation being a key driver for the Reserve Bank's decision. What's the things that have been causing these factors to really drive the Reserve Bank to raise rates again?
Yeah, some big changes to inflation, some massive increases. It's been influenced by things like petrol prices, energy prices, rental increase. And although there was a bit of a dip in inflation rates recently, they've remained well above the Reserve Bank's comfort zone and exceeded the target of 2 to 3% for almost 10 quarters now. So it's really in an uncomfortable spot. And like you said before, it's kind of getting stickier, and they're worried that if they don't sort of nip things off at the moment, it's going to be here to stay and cause bigger issues in the economy.
Yeah, current projections suggest that it could take another 7 quarters, nearly 2 years, possibly even longer, for inflation to reach the Reserve Bank's target range, which is between 2 to 3%. So worrying times ahead. They also talk about the lag periods between when the Reserve Bank makes their rate adjustments and it really having an effect on the economy. We definitely do see that these rate rises don't affect the community equally. It certainly affects those younger borrowers or borrowers that have gone into the market recently with the jumbo mortgages. So definitely going to be interesting times ahead. Consumer spending, the Reserve Bank is obviously concerned about sustained higher inflation, with consumer spending still being robust and risk that inflation won't ease as it's needed. Guys, if you do find value in this video, please consider hitting that subscribe button, as it really does help out the channel. And a big thank you to all our subscribers for your support. Inspires us to create more content we hope you enjoy. Jaden, what does the future outlook look like from here?
So this move by the Reserve Bank has really signaled that they are pretty alert and really conscious that there is potential control and potential need for further interest rate rises. As for the next month, a lot of economists are split, saying potentially they're worried about the impact it's going to have on retail sales if they go too hard now. And for the lag effect reasons, they don't want to go too hard. But Australia has lagged behind a lot of the developed world as far as their cash rate and the moves the Reserve Bank has made, just because of the way our economy is structured, even the way mortgages are structured. I've had a lot of people ask me this week, well, why can't you get a 30-year loan term or 30-year fixed rate like you can in America? And it's the way that we're set up. In Australia, the majority of borrowers go for variable rates, so they're a lot more susceptible to changes in the cash rates. And that's where our monetary policy can impact and can move on a lot quicker than overseas in America, especially for the housing markets. But it still takes time, and that's what the Reserve Bank's still trying to feel out and make sure they don't go too hard too soon, because it's going to affect unemployment and other sectors of the economy.
100%. And the situation is evolving. The Reserve Bank is readily available, ready to make a move if they need to do it. But they're also teetering on the edge. They don't want it to be a dominoes effect where they push too hard. And then like that elastic band, it comes straight back at them. And we have mass unemployment. We have issues with borrowers and their repayments and foreclosures. So definitely an interesting time ahead. If you are being affected by these mortgage repayments and increasing costs, it's certainly time to review. Start off with having a chat with your lender. See if they can get your rate down. That conversation might see you be able to save 0.5% in interest. If that doesn't help, we'll get in touch with a mortgage broker like ourselves. We can review the market, see what the rest of the other lenders are offering you, and even potentially get a cashback. Did you know here at Hunter Galloway, we're a mortgage broker and deal with people Australia-wide? Reach out with us directly on 1300 088 065 or visit our website huntergalloway.com.au. Guys, until next time, thanks for watching.